thank you everybody for coming along today. We've now got everything working correctly, so we'll get it underway. So we have the distinct pleasure to introduce Sharon Zollner, who, if you don't know, is the Chief Economist from the ANZ. And if you don't know, then you haven't been reading the newspapers, because she's in it pretty much all the time. We're very honoured to have you come and present to our clients, Sharon, so thank you very much for your time. And without any further ado, because nobody's here to listen to me, I will hand it over to you.
Thanks, Jake. I will go straight to my slide pack. There we go. Moment to rearrange your screen if you need to. Yes. Uh-oh, that's not good. There we go. Back on my slides. Right. Good stuff. Okay. So what have we learned about COVID? Quite a lot, obviously, medically, but here I'll focus on the economics. Basically, central banks and everyone else assumed that it was a big net negative demand shock, a bit like the global financial crisis, that it would really hit confidence really hard. It would stop employment and investment in its tracks. Households would stop spending. House prices would fall double digit. And the best thing that monetary and fiscal policy could do would be to backfill demand. But as it turned out, confidence bounced back very quickly, particularly in New Zealand when we actually had long stretches without any COVID in the economy. Monetary policy and the suspension of the LVRs and all the money printing that went on and the flip to probably a lesser degree provided a massive easing in financial conditions, and the fiscal spending supported incomes through the lockdowns, and the shocks to demand were very short-lived. And then the housing market took off, of course, as we know. On the other side of things, the supply shock was quite persistent, and it's still going. It keeps getting more legs to it. So the transitory camp is looking very empty. These disruptions, the latest leg is, well, obviously Russia's invasion of Ukraine, which is mucking up supply chains for a whole lot of things, but energy and wheat in particular. But also now China's got Omicron, and they're still trying to pursue COVID zero, and COVID zero and Omicron are simply incompatible, so something's going to have to give there. But no matter what policy choices they make, they're looking at quite a lot of disruption to their manufacturing and transport and everything else. But it'll depend on the efficacy of their vaccines, but it does appear they're not as effective as the mRNA ones. So yeah, we're waiting to see what that will mean. So plenty of supply shocks on and on and on and on. They have certainly been persistent. At the same time, consumers, because they couldn't travel so much, and particularly in New Zealand, of course, with our closed border, that shock lasted longer. So a lot of new kitchens instead of trips to Europe, a lot of spas instead of trips to Australia, etc., etc. So that substitution towards goods was huge as well, and very resource intensive. So you add together all of that, a very constrained supply side. I didn't even mention labour shortages, which obviously have been hugely important too. And lots of demand, then that's a really, really inflationary mix, not deflationary. So that's basically a huge policy mistake from monetary policy in particular. I don't think anyone's suggesting that fiscal policy should not have supported incomes through the lockdowns, for example, but it's probably overshot a bit as well. And now, of course, we've got this war in Ukraine on top of things. And history may well get subtly rewritten, at least by central banks, to say, oh, we were doing fine until Putin came along, but that's not true. They were not doing fine at all. This is all that, those inflation numbers are pre-Putin. And as you can see, it's a bit of a stuff up. Yeah, to put too fine a point on it. And it's everywhere. So that's the context for where we sit today, with central banks' backs against the wall. So looking at how businesses are feeling, this data is only up to February, but you can see that sharp drop at the end. That's probably Omicron disruption, but how much we get back we'll have to wait and see. There's a lot more going on than just Omicron, obviously, and the sharp rise in interest rates, and what increasing worries about the world outlook will be weighing as well, probably. And in any case, it's definitely rolled over and past its best. Here I've standardised all the series so you can compare them with each other. And the good news is that employment and investment intentions are holding up better than, say, profitability, export intentions, and indeed own activity. So firms, that does suggest firms are looking through some of this near-term disruption and seeing better times ahead. But the news flow isn't great. And in particular, they'll be a bit freaked out by the collapse in consumer confidence. It was spectacular. So an easy assumption is that that's all just Omicron and the shock of realising that the government's not going to stop you getting it anymore. But it's interesting to see that, it's taken quite a hit in Australia as well. And it's as inflation expectations rise. I think it's easy to remember that households hate high interest rates and forget that they also hate high inflation. And there's been story after story after story about high inflation. Inflation Nation, the Herald's running an entire series aimed at boosting inflation expectations. That's actually not the aim, but it's going to be the effect. Anyone who didn't know there was inflation before certainly knows about it now. And we actually put out a piece today just looking at the main focus is the fact that petrol prices in particular have an outsized impact on inflation expectations. They're a very big, very visible price, and they are unfortunately, of course, quite a bit higher. But in terms of firms' biggest problems at the moment, this is December because we only ask these questions quarterly, it's still finding skilled labour, paperwork, but that's not particularly cyclical, and non-wage cost inflation has definitely increased a lot as well. High rates of pay, not so much of an issue yet. But we have actually made some changes to our business survey, and rather than just asking up, down, sideways, we're now going to ask firms to put a number on their cost and their pricing expectations and intentions, and also a number on their wage settlements in the last 12 months and they're expected in the next 12 months. So we're going to have a grand total of one data point when that comes out in just over a week, 10 days. But I'm really excited to see that data. I think it'll be closely watched by the Reserve Bank as well. It's clearly cost inflation is an increasing problem for firms. It hasn't been so much of a problem so far. Not that it hasn't been huge, but they haven't had any problems passing those costs on. But as consumers become more price sensitive, which certainly the plunge in confidence suggests they are becoming, then it's going to be harder to do that, and firms' margins could get quite squeezed. So worth keeping an eye on that. Well, we'll now have a numerical measure of margins, which would be cool. I suspect they're not doing that well. The labour market's doing very, very well, though, and actually the latest monthly job numbers were good again. So this is simply a very simple measure of labour tightness, but you can take any of them. They're all screaming the same message. This is just number of job ads divided by the number of unemployed people, and it shows that basically just before COVID hit, the Reserve Bank estimated that we were at maximum sustainable employment. We are now miles past it. So you can see why the central banks got it wrong initially, but and so I'm not throwing stones at them for that. Our forecast was certainly no better, but they were slow to recognise the strength of that V. We didn't believe our business outlook survey, and we should have. I believe them from now on. But basically, with the labour market that tight, the conditions are ripe for a wage price spiral. That's the bad news. The good news is that hopefully means that the Reserve Bank can actually slow the economy down quite a bit before lifting unemployment meaningfully. The counter to that again is that you've got to ask yourself, are they going to get on top of inflation without requiring a meaningful lift in unemployment? You've got to ask that question. When unemployment's at a record low, despite record high labour force participation, and they're really worried about inflation expectations and a wage price spiral, I'm not entirely convinced there is a path for the official cash rate that gets inflation under control in a reasonable time frame without a recession. So I'll put that out there right now. It's our forecast, but it's the holy grail at this point. We can't really forecast recessions because they're kind of an exercise in crowd psychology, which is pretty hard to pick. But if I was sort of taking a weighted most likely scenario as opposed to an internally consistent wheels don't fall off track and then talking about the risks around it, which is what you have to do in your forecast, I think there's a very, very high chance that Reserve Bank of New Zealand and other central banks are going to hike us into recession because they simply have no choice. Because if they let inflation go to the moon, that in itself will probably cause a recession anyway, and then you'll come out the other end of it and still have high inflation, which would be even worse. So there aren't really any low risk or great policy options at this point for central banks. So that's important to understand about our aggressive OCR call. It's not that we think it's not going to hurt and that the economy is going to be all fine and dandy necessarily. So the border is now open, and the remaining restrictions are going to disappear pretty soon, and it seems likely that the vaccine passes and whatnot are going to have to go as well, because it's going to be a bit of a turn off for tourists if they're going to have to get a vaccine pass and all that sort of thing. So I think those restrictions are on their last legs too. But this is just a chart of the unemployment differential between us and Australia and the trans-Tasman net immigration. So first point is to note that it's usually negative on average over history. You can take it back a lot further than that and see that. And so we've got the unemployment rate in New Zealand sort of staying roughly where it is, and our Australian colleagues have the unemployment rate falling over there. So that relativity moves in that dotted line there. And that does suggest negative net migration to Australia, which is certainly in line with the anecdote that we're hearing, particularly obviously the people we can least afford to lose, like nurses, software developers, engineers, etc., etc. Much more money to be made over there, and in some cities, cheaper houses. So then the question becomes how fast we can backfill from elsewhere to avoid actually getting negative net migration. And there will be demand to come from New Zealand. In fact, we're so far from Ukraine, probably won't cause any harm. But on the other hand, anyone who Googles house prices and wages is much more likely to choose Australia. Immigration in New Zealand's a bit distracted with processing 160,000 residency applications from people who are already here and already in the labour force, for example. And the whole world's competing for workers at the moment. So there is actually a risk net migration could be negative over coming months. There's 2 or 3 years worth of young people due to head off on their OE and breaking down the door potentially. The upshot is, it's very uncertain, but it's certainly not going to solve our labour supply problem instantly, this opening of the border. And in terms of tourism, it's so seasonal that really, while it's a win for Queenstown over the winter, in New Zealand net, we typically send more Kiwis overseas than we get tourists in the winter. And there's an awful lot of Kiwis been waiting to go overseas and visit family. So we'll probably actually, the opening of the border will be a negative for GDP in the near term, but then hopefully we'll have a really good inflow of tourists in the summer. But there's always the risk another Omicron variant will have come along. Deltacron is the latest I read. Basically Delta with the Omicron spike. So yeah, we've got that sitting in the wings. But then, yeah, there's always that random roll of the dice thing. But at least the certainty that the government's providing now hopefully means that there's plenty of planning time for a good summer season. So households are freaked out. If I were to plot the overall headline confidence measure here, it actually goes lower than when COVID first hit. It goes lower than in the global financial crisis hit. So it looks like a bit of an overreaction, to be honest. But the best series for predicting retail spending is actually this one. The question, is it a good time to buy a major household item? And essentially households are saying, no, it's really not. It's about as good as 08, 09, in fact, slightly worse than that. So it is worth noting that in between the 2 COVID outbreaks, households were saying one thing and doing another. So you could argue that they will continue to spend even though they know it's a bad idea, but I don't think so. I think that was a lot to do with, we were in the middle of a pandemic, but we had a housing boom and we were all feeling super rich and interest rates were low. Now interest rates are going up and house prices are falling, and we've still got all the COVID uncertainty and everything else. I think they mean it this time. So that does suggest real retail sales falling by 8%, but actually in nominal terms, that's about square, because that's almost what we've got inflation running at. We've got it peaking at 7.4. So we now have to actually draw a distinction between real and nominal in a way we haven't had to do for a long time. But of course, household firms' costs are going up, so flat is not a great outcome in terms of your revenue. So why are households more cautious? Well, higher mortgage rates are a big part of it. The higher cost of living, households hate inflation, and now petrol's obviously rising as well. Wages will catch up, but in our forecast, not until next year sometime, or maybe, next year, I think, because of the lags that are built in there. So we're sort of right in maximum squeeze where inflation's gone poof and wages take longer to catch up. Of course, the Reserve Bank would like people to be restrained in their wage demands, but then you're just asking the lowest income earners to take the biggest hit, because the people with the least buffers in their budget. So how the pain gets shared will just depend on the speed of tightening. You can tighten quickly and hopefully tighten less, or you can tighten slowly and end up tightening more. So that'll affect different people differently. The firms' margins will take some of it, borrowers will take some of it. Unemployment will get some of it that way. None of it's fun. The fighting inflation is not fun. It's the opposite of the housing boom and the woohoo, we're all rich times that we had. We've had an incredible boom, and risks are we're going to have a remarkable bust. That's just how, house prices are up over 40% over a period in which New Zealand's gotten poorer. It doesn't make any sense. COVID risks are still out there, obviously, but house prices falling, that wealth effect going into reverse potentially, though house prices are still well up year on year. Offsetting all that list is the strong labour market and good job security at the moment. But even there, obviously, the higher interest rates and the slowing housing market could make a dent in labour demand, but just more generally, the real wages are going backwards. Hospitality is obviously doing it really tough. This is our ANZ card spending data, so you can see it's not quite a lockdown, but it's a lot of cumulative pain there, and likely to be, we can already see it as the last straw for many firms. Now they're going to come out into an environment where households are going to be more cautious with their spending, more likely to trade down to takeaways or dine at home. So turning to the housing market, you can see there's no question now that baby's turned. In fact, it's plummeting about as fast as it went up in terms of prices now. That's price inflation, of course. But actually, in outright level terms, house prices have fallen in the last 3 months. House sales actually peaked a year ago, but more than a year ago, and also heading south. So we're picking minus 10%, which would be about what we saw in 08-09. I'd call that a soft landing, but we're all very humble about our ability to forecast house prices after our shocker in 2020. But I might pick a number, but that's what 10% looks like. You'd have to say that you can see what I mean by it being a soft landing in terms of that light blue levels number. If we can get away with that, we've done very well, frankly. So why are house prices falling? Well, there's a long list there too. So obviously mortgage rates going up, banks will be increasing their serviceability test rates as well, which means you can just borrow less, all else equal. The affordability is ridiculous, just trying to get together a deposit, it's hopeless. The LVRs have been tightened up. The CCCFA, they have loosened it a bit, but it's still, I think, on balance, still sand in the gears. The tax changes for investors, they get gnarlier as mortgage rates go up. Mortgage rate increases now have a tax increase attached to them if you're a property investor. And it's very hard to know how that's going to pan out, but if you're a highly leveraged property investor, the net present value of your property is starting to look a bit rubbish. Supply is, obviously we've built a heck of a lot of houses, but also the number of properties available is going up as everyone's realising this is the moment to sell, but right as sales are coming off, suddenly the available listings are doubling, blowing out quite quickly. So that changes it to a buyer's market very quickly. And you can see the auction clearance rate in Auckland, for example, is still plummeting. In fact, it's getting down to 20-25%, the point at which people will just give up on auctions. So it's probably hitting its limits in terms of what it can tell us, but it is telling us things are continuing to slow. And the migration is obviously important. It's entirely possible that Auckland at least may have overbuilt to some extent, or at least some types of housing. So yeah, there is fragility from the fact that the house price to income ratio has gone so nuts, but to get an actual crash, you need to have unemployment rise and have a lot of forced sales, and that's not our forecast. But as I said, economists have a terrible track record of forecasting recessions. Typically, we only realise when we're in the middle of one. And it has to be a very real risk globally. We had Powell overnight basically saying they are very likely to go 50s. So yeah, and that's despite downside risks. But his line was basically, without price stability, you can't have sustained maximum sustainable employment. So basically, we're going to focus on that long game. But if we let inflation go, we're stuffing the economy long term. So we're going to have to put up with some short-term pain and reading between the lines to accept the risk of hiking the economy into recession. Because if we don't, then, it's sort of, we've failed in our number one task, which is to sort of keep, and it's not just sort of an academic nicety to keep inflation under control. It really causes a lot of damage, makes it, because high inflation is also very volatile inflation, and then it makes it very difficult to make your investment decisions, for example, when you really don't know what your real interest rate is going to be or what your real returns are going to be. And at the moment, central banks have got political cover insofar as governments, whether that's Biden or Labor, are being blamed for inflation, which is, try living on the other side of the terrace, I would say. But it's that they are being blamed because people blame the government for everything. So they will be keen for the Reserve Bank to head it off. And the opposition has said that they would like to see the Reserve Bank's target simplified to just be inflation and get rid of all the other nice to have. So they can't then turn around and tell them they should stop hiking because the housing market's looking a bit wobbly or something. Raising rates as fast as we're forecasting would be a highly risky thing to do. Very high risk of sending the economy into a recession. But not raising them, that we think the Reserve Bank will conclude that not raising them that aggressively is even riskier. So not a great set of options at this point. And it's quite hard for the market to get their head around the fact that central banks are no longer backstopping, well, if not equities, then certainly near-term growth. We've had more than a decade of central banks backing off, and anytime, in some cases, equities wobbled, but more reasonably, anytime it looked like growth was flagging. But when you get a big negative supply shock, it's inflationary and it's bad for growth, and central banks want to ignore it, but you can't if inflation is looking persistent. And it is not just imported tradable inflation that's the problem. We've got non-tradable inflation at 6% in our forecast, which is at least twice what you want it to be. And its inflation expectations are too high, and any reasonable forecast of wages is going to be starting to flirt with unsustainability in terms of inconsistency with the inflation target. So it's getting quite embedded. The whole policy targets agreement and everything is all designed to look through one-off oil price shocks because they're really bad for growth. But if you're worried about inflation expectations, you can't. You don't have that luxury anymore. You spent your bullets in terms of giving growth a chance already. Here's building consents. Yeah, as you can see, they're pretty volatile, but we think they've turned. It's suddenly looking very risky to do a property development at the moment. You don't know how much it's going to cost you to build it. You don't know if you're going to be able to find the staff. You don't know if you're going to be able to find the jib or the timber or the roofing iron or the plumbing materials or anything else. And then you don't know what it's going to be worth at the end of it all. Prices are currently going down. You add all that up, and suddenly there's quite a lot of properties being put back on the market for someone else to take a punt on. So that is changing quite quickly. So construction's about more than 10% of employment. So it really does matter for the labour market. It's worth keeping an eye on this sector. The construction sector gets itself in trouble when it's too busy anyway because of cost overruns and cash flow problems and delays. And even the smartest, most clued up, best building companies out there cannot finish a job on time and on budget at the moment. So the risks are quite elevated, I would say. Firms think they have a 2-year pipeline of work, but pipelines have a way of springing holes at about this point of the business cycle. Longer term view, you may have seen this chart before, but basically the top chart's from 1993, and that pretty much underpins, well, that's just because the data starts there, but you could go back further. Essentially, that chart underpins the well-held view that house prices are a one-way bet, that you can never go wrong with housing, that you should never sell a house, you should buy the biggest, most expensive house, borrow as much money as the bank will lend you, etc., etc. It has been a spectacular investment strategy for decades. However, the bottom chart, the red arrow, covers the same period as the top chart, and it shows that increase in the house price to income ratio has been underpinned by a steady decline in nominal interest rates. So basically, in a low inflation, low interest rate environment, you can borrow a heck of a lot more as a proportion of your future income stream than you can in a high inflation, high interest rate environment, even if the real interest rate is the same, and the real interest rates come down as well. But I've just shown the 5-year bond yield here because it's the longest data series I could find. It goes back to 1947, and the main point of that chart is that last period has been unusual. It's just, one period and it's done, because obviously with inflation now, interest rates are having to rise, and Whether we're going back to that very low inflation world, I think is highly questionable when you think about, well, climate change and its impact on agricultural production, as well as all the mitigations we're going to have to do. You think about deglobalization, whether that's related to Russia or to China or to pandemic risks. This globalization that has led to pricing efficiencies has now been shown to be actually extremely fragile. And so firms are needing to build a lot more robustness into their supply chains, whether that's holding a lot more stock or manufacturing locally at higher cost or whatever. It's all more costly and inflationary. Plus, basically, this huge flurry of inflation is likely to have very persistent impacts on inflation expectations and therefore on what a real interest rate actually is, and therefore on how high nominal interest rates have to be. So the upshot is, I reckon that period's over. It was very weird and it did a lot of damage, and we're only going to see the consequences of that damage in the next recession, which most people seem to be picking for next year if they're talking about it. And we're going to have to clean up quite a mess. Within the fact that people have taken on enormous amounts of debt and asset prices have left reality behind in terms of traditional metrics of overvaluation, whether you're talking about housing like that chart above, or price to earnings ratios in equities, or whether you're looking at non-fungible tokens and wondering what their fundamental value actually is, or the 1,001 cryptocurrencies you can buy. I mean, there's all sorts of evidence out there of people buying investments they don't understand or can't be bothered understanding because they're going up, which is, of course, the sort of behaviour we saw in 2005 to 2007 didn't end particularly well. So that's quite a U-turn in New Zealand swap rates there, and of course mortgage rates have followed. So there's really not anywhere to hide on the yield curve anymore. It's quite common now to roll off onto a rate that's twice what you were paying before, because the maths does get quite weird when you've been around zero. Rate increasing from 0.5% to 1% is a doubling. From 0 to 1%, you can't even calculate it, it's infinite. So households are looking at quite big percentage increases in their debt servicing costs. It's going to hurt. There's a lot more to financial conditions than just monetary conditions, obviously. So this is our financial conditions index, which is made up of lots of things that make borrowing easier, whether that's the price of borrowing or the availability of borrowing or the amount of collateral you have, etc., etc. And we've just calibrated it to match GDP roughly at the bottom left chart there, at least until GDP went nuts because of COVID. And then we've put in our forecast for mortgage rates and house prices. We haven't made any assumptions about equities or credit conditions or credit spreads, and there's downside risks to all of those. But you can see there at the top, monetary conditions are already tighter than they have been through that whole chart, basically. And they're going to go a lot tighter yet as house prices go backwards in particular. That makes it much harder for the likes of small businesses to borrow as well as households. It's tighter since 2009 in our forecast, before they start to turn around as those house price falls ease. But obviously there's huge forecast uncertainty around that. But the fact is, this just gives you a sense of how much the Reserve Bank's going to have to slow the economy down. It's got, on the right-hand side there, you've got growth basically heading down towards, implied around zero. But the GDP numbers are still absolutely all over the place. But that gives you the flavour of it anyway. So why do they have to do this? Well, whether you look at cost expectations, pricing intentions, or inflation expectations, they've all done a bit of a hockey stick. And the most concerning is probably inflation expectations, which are doing their best to look exponential at this point. Business inflation expectations at nearly 5.5%. Your inflation target's 2%. You're missing by a country mile. And over 90% of firms experiencing higher costs. You're starting to get inflation because inflation, and that's a big, big problem. So it's not just headline inflation, core inflation, non-tradable inflation, forecastable wage growth, inflation expectations. All these things are broad-based medium-term inflation pressure that will not go away on its own. You're going to have a pretty marked slowdown to open up a negative output gap below what's already a constrained level of potential output. It's a double hit, double whammy. The economy can't run as fast anyway, and now you're tying its legs together as well. So yeah, Reserve Bank credibility is on the line. I remember hearing Adrian Orr in a press conference say, "I will not play fast and loose with my inflation targeting credibility." And we believe him. They very nearly hiked 50 in February, so the hurdle to hike 50 is actually really quite small. And we've had upside inflation shocks since then. So it turns out from two completely different surveys that household inflation expectations and retailer pricing intentions match each other really well. So there's a little symbiotic thing going on there. If someone goes into the shop and go, "Oh, my shoes have gone, the shoes I wanted have gone up $10. And they go, "Yeah, inflation, eh? Yeah, isn't it terrible?" Everyone's on the same page, which is, precursor to a wage price spiral, one would suspect. And on the right-hand side, you can see firms' pricing intentions, with well over 70% of firms intending to raise their prices. That suggests inflation pressure. Yeah, well, obviously it's not a precise relationship, but definitely consistent with our forecast that inflation is going well over 7. So here's just one supply disruption that's not going away here. You can see the World Container Index, that's what we're most exposed to, still going up. And no one really seems to know when it's going to turn around. And it's problematic for retail, manufacturing, construction, agriculture. We ask in our business survey how much grief firms are getting from shipping disruptions, and it keeps increasing. Increases the cost of imports and disrupts their exports. And now with Omicron, it's only a matter of time, one thinks, until that causes a bit more pandemonium at their ports and their internal transport links and everything else. So dairy farmers are pretty happy because dairy prices in that top chart are very correlated with oil prices. So we as a nation have got a pretty awesome hedge there, particularly since our cows eat grass and not grain. The price of grain is spiking globally because Ukraine is the breadbasket of Europe. But that doesn't have any consequences for our grass growing ability. So that's both higher oil prices and higher dairy prices are inflationary, so it doesn't help the Reserve Bank from that point of view. But in terms of backstopping our national income, net national income, it's very helpful. And what's weird is that no one seems to have told the New Zealand dollar that it's supposed to be correlated with dairy prices. So it's being held down presumably by risk appetite. It, for example, took another, or in rate differential. So it hasn't jumped on the commodity horse. So that's an unprecedented period of divergence between dairy prices and the New Zealand dollar. So that is not helpful for the Reserve Bank insofar as it makes imports more expensive, keeps tradable inflation higher. When the currency might jump on that commodity horse is very hard to predict. But I would say that as the dust settles and people start to think, well, who's the most exposed to this Ukraine situation? It's not New Zealand, really. We've been winning from higher food prices for a long time now, decades in fact, and the relative price of food would seem likely to continue increasing, both because of geopolitics and climate change. Of course, we can't just increase volumes. It's pretty much impossible to get the dairy conversion through, for example, and we need to decow a bit anyway on our existing dairy farms, but at least the higher prices are at least get some income, higher income through. So there's our inflation forecast. As you can see, we've got non-tradable at 6, tradable hitting 9, but it's that non-tradable that really matters. So that's in a nutshell. It's not coming back quickly because the wages are just sort of kicking in. And whatever happens to oil and petrol price taxes and whatever, inflation's already far too high. And the OCR is barely off its lows. I mean, 50 basis point hikes sound ridiculous, but so does a 1% OCR when inflation is 7. You've got to actually just step back and look at the levels here. So the top chart shows the real OCR. If you subtract inflation expectations, there's a couple of different measures there. But whichever you use, the Reserve Bank's still going backwards. They're trying to run up a greasy slope, and they're not making any progress. I don't think that falling real interest rate is going to stimulate a heck of a lot of housing boom or a lot of business investment at the moment. We're not in that stage of the business cycle. But you do need to get back to neutral and beyond neutral at some point. And the bottom chart shows that had the Reserve Bank responded as they typically have in the past to inflation deviations from target and the output gap they were observing, in particular the unemployment rate, they would have hiked a lot earlier. Even if you build in smoothing to match history better and just reflect the fact that central banks take a while to be convinced and there's benefits to being predictable, they still would have started hiking a lot sooner and wound back QE quicker and all that sort of stuff. So essentially they're about a year behind where they should be, where should here is just taking their historical performance as opposed to necessarily what's optimal policy. So that's also a big part of the reason why we think they'll just get a bit of a move on, deliver a couple of 50s, and then they'll have the luxury of going 25s from there, because by the second half of this year, it should be pretty clear that the economy is doing quite tough, actually. And maybe by then we'll see some of these inflation indicators at least slowing down, if not yet turning. Hopefully some signs of getting traction with policy. So we've got the OCR going to 3.5. The Reserve Bank had 3.35 in the February statement. The market, it's been waxing and waning depending on international developments and what global central banks say too, as much as anything that's happened here. But at the moment, they're broadly on board with our call. So we've got, 50s in April and May, and then steady 25s after that, which takes us to 3.5 by April next year. So you can look at that 3.5 in two ways. You can go, no way, we can't handle floating mortgage rates of whatever that would be, high sixes or something, in a falling housing market. Are you insane? People have got $1 million mortgages. But then on the other hand, you go, a 3.5% peak in the OCR when inflation peaks at 7.5, that's pretty good going. It could have gone a lot worse. So there is a real risk that something breaks before the OCR gets that far, and that's both in terms of the level of the OCR and the fact that it's taking a year, over a year to get there. There's plenty could break in the next year. So the housing slowdown could get very messy. The labour market could deteriorate actually really quickly. Inflation expectations could tank. That seems very unlikely. Or global markets could tank, which seems less unlikely than inflation expectations tanking. For example, there's probably more things you could add to that list. But if the wheels stay on the car, then we think the OCR's got quite a big job to do, basically. And you can imagine scenarios where it has to go higher yet if inflation just refuses to drop. But you can also imagine scenarios where it doesn't get nearly that high. Just one point on debt servicing. There's a notion out there, and certainly we've been talking this way, that the OCR simply can't go above whatever, X2, say, because households have taken on such huge mortgages. And it's true that they have in the last 2 years, but if you actually look at aggregate households, and remember that most households have not bought a house in the last 2 years, you can actually see that the interest rates could go quite high before we got anything like the peak in debt servicing that we had just before the global financial crisis. So this chart was done relative to our 3% peak OCR. So that would be the OCR roughly. This is the effective mortgage rate, but basically the OCR going to 6. That's about what you'd need to have. But this chart does assume that household income trucks along, aggregate household income trucks along at 5% growth without the unemployment rate suddenly spiking, for example. The other point to note is, of course, the housing market was booming through that period and the central bank couldn't stop it. The Reserve Bank was really struggling to slow it down. They paused the OCR and then they delivered another couple of hikes just before the GFC hit. We're in quite a different world now with house prices already going backwards, and how much that wealth and confidence effect is worth in terms of effective OCR hikes is hard to gauge, but you could see in our financial conditions index that it's pretty meaningful. So in that regard, we're not comparing apples and oranges here. But I guess the main point from this chart is that it's not likely to be debt servicing that actually ends up limiting how high the OCR can go. It's probably more actually house price falls that we would see if we had an OCR of 6, and the impact of that wealth channel on household spending and obviously construction and everything else. That would probably be the channel that caused things to break first. That's not to say that some households aren't doing extremely hard, and that, of course, the rise in living costs plays into this as well. You've got a lot less disposable income if you have a long commute and have to fill your petrol car every week, for example. And that's not really taken into account here either. So there are definitely limitations to this. But yeah, the upshot is that it's just worth remembering, not everyone has taken on $1 million mortgage in the last 2 years. A third of households don't even have a mortgage, and a third of homeowners have already paid off their mortgage. And of those who do have a mortgage, a lot have already paid down a lot of debt already, or at least bought their house at a much, much lower house price level than there is now. So they're still sitting on really positive equity. So there's going to be some pretty sad stories out there if our forecasts come to pass, but not enough to derail the economy. So bond yields, a bit of a battle going on between inflation fears on the one hand and safe haven status on the other. Bonds are the traditional safe haven when trouble strikes, but if trouble is that inflation's too high, then they're a pretty rubbish safe haven. It's worth noting that if inflation gets the way on central banks well and truly, then those inflation expectations must go into bond yields eventually. And then if central banks try to do QE to bring them down, for example, people will go, now they're just printing more money, and inflation expectations would jump up again and long yields would go again. So in the end, central banks cannot control the long end of the curve if they lose control of inflation. They'll have that in mind as well. But certainly the bond yields we're seeing at the moment would seem to bear no resemblance whatsoever to any kind of reasonable estimate of what actual inflation is going to be over that period. So you're pretty much locking in negative real returns. And so these bond yields maybe make sense if you're pricing them off expected policy rates over the period in question. But even then, you're making some pretty big assumptions about where neutral nominal is going to be over the next while and whether it's going to look the same as it has over the last 5 or 10 years. Yeah, maybe better to put your money under the mattress. Anyway, I'm not an investment advisor, thankfully. I'll leave that to you guys. Equities, lots of wobbles, I'd say, but some pretty impressive bounce backs too. China's perhaps the most interesting one. Lots of things going on there. Regulatory crackdown on the property sector and on the tech sector generally, and then a US crackdown on Chinese firms listing in the US, maybe not meeting their obligations. Then Omicron, and then growth slowdown fears and problems in their property sector spilling over into their high yield market, for example. But then it did appear last week that the government threw in the towel and said, all right, we'll just maximise near-term growth again, forget all about moral hazard and structural, all this and that and the other thing. They hit some sort of pain point and got freaked out, and back to moral hazard, shove it under the rug policies. But there are question marks around the sustainability of that. At some point, you've got so much stuff under the rug you can't walk on it anymore. I don't know if we're at that point, but there's a lot. You can see that bounce back was not 100%. So people are still pretty dubious about the outlook for China's growth this year. More generally, risk appetite's under threat as central banks change from we got you back to take your medicine. Sorry, we're not your friends anymore. We are not going to cut rates if equities fall. We've got a job to do. Stop knocking on our door. We're not listening. That's quite a different environment for investors. And risk spreads are starting to move. This is the China high yield bonds, obviously impacted by the property sector there. So it's one of the most dramatic ones, but you can see their US high yield also starting to move a bit. And that those high yield spreads have obviously been artificially compressed by the Federal Reserve buying junk bonds as part of their QE, and they're now talking about winding up QE pretty quickly and them having to stand on their own 2 feet. In Europe, you've got the equivalent situation with the European Central Bank having done debt mutualisation by stealth and buying unlimited quantities of Italian government debt, for example. But if they're going to have to wind back QE and stop printing money, then their ability to hold Europe together with sellotape that way is also going to be limited. So and we are actually seeing the peripheral spreads in Europe starting to move as well. So yeah, high yield versus high grade, European periphery versus core, China versus the G3. Yeah, basically risk is becoming a thing again, and investors haven't had to think about risk for a very long time because central banks have been hiding all evidence of it, but they never actually got rid of the risk itself, and it's just starting to bubble up again. And just finally, it's just worth noting that while the last 2 years, on the whole, you'd look back and go, well, that's actually gone all right economically for New Zealand, not exactly rock star stuff, but yeah, in pockets of pain, huge in the tourism and hospitality, but overall, it's not been bad. We've got a record low unemployment rate, but it's just worth remembering that has been achieved by a massive increase in debt, government debt in the grey there, and household debt to a lesser extent. Firms, on the other hand, have been quite prudent, which is a good thing. But it's not a trick we can keep repeating. Monetary policy and fiscal policy both boost growth by bringing forward spending from the future. So households borrow more now and have to pay it back, and government borrows more now and has less fiscal flexibility in the future as well. So it's not a trick we can repeat ad infinitum. And this is a global theme. Obviously, the increase in debt has been massive ever since about 2008, and then absolutely turbocharged by COVID. Fiscal restraint, the idea that governments might need to limit their debt, went out the window completely with QE. But at some point, it might become a thing again. US government debt is awfully close to 100% of GDP. But hey, there's nothing like a bit of inflation to inflate the nominal economy and your tax take and inflate away your debt, if you can make the debt payments in the meantime. That's the catch. But a bit of inflation, yeah, it's not all bad insofar as it also greases the wheels for, say, a real house price fall in New Zealand. We've got house prices falling 10%, we've got inflation going up 7.5%, that's a 17.5% fall in real house prices, which is starting to make a decent dent in terms of putting things back to some kind of reality. That is, of course, assuming that wage growth eventually catches up with the new price level, which it will. But in the meantime, we have to get through this period of potentially much higher nominal interest rates than anyone was really seriously considering as a possibility. And there will be a bunch of people who have taken on debt that will struggle with that. If you don't already subscribe to our publications, it's a QR code, or just research.anz.com. You have to remember. Stop sharing. Here we go.
Oh, am I back?
You're back.
Oh, phew, got the system working and everything. All right, thank you very much for that, Sharon. Excellent presentation as per usual. I had a few questions come up. The first one is to do with me. Who cuts my hair? I do. You'd be surprised to know. So thank you to whoever asked that question. Is a copy of your slides going to be available, Sharon?
Oh, I can do that. Yep, no problem.
Yep, great.
That's
so
an
we
easy
can get
question.
that through to us. It's a wee bit harder from here.
Oh.
At what point do negative factors start to impact expectations and the self-correcting parts of the cycle start to kick in? For example, lower house prices and asset prices impact willingness to spend.
Yeah, so basically, when will monetary policy start working? I think it is working already, insofar as these house prices are falling in the last 3 months. Some of that, I think, has actually been turbocharged by accident, although some conspiracy theorists say by design, with the CCCFA legislation. And even if they were to scrap that legislation completely, I don't think you'd get a full bounce back, just insofar as it hit the housing market at a very vulnerable time. You can see it already in the fall in consumer confidence. So we're not doubting that the economy is going to slow this year, and we're just about to finalise and release our updated GDP forecasts, reflecting our new OCR track and the latest data, and it's obviously clear which direction those revisions will be in. Monetary policy is working. The problem is inflation expectations are very, very persistent and look like they still have a way to go, and the lags are quite long. So the Reserve Bank, the odds of them oversteering is quite high. They oversteered on the way up, and they'll probably oversteer on the way down, because they move the rudder, and then the half the boat moves in terms of growth, and then you only find out the inflation consequences of that 6 months later again. So it's a bit of a dog of a canoe to steer. So I think it's happening already, but we've just got to get our heads around the fact that slower growth is not a reason for the Reserve Bank to stop anymore. They're going to need to, it's all about their inflation forecast. When they feel they can confidently forecast that inflation's on its way back to target and that they've cracked it, and we're a long way from that point.
Okay, great. Thank you for that. I've got a amusing question. they're asking you to forecast where the 1-year residential mortgage rate is going to be at Christmas of 2022.
Oh, well, we do forecast that. Actually, it'll be in our property focus that we put out yesterday. I can't remember off the top of my head, but basically that 1 year, well, if we've got, over the next 12 months, by December, we've got 50 points in April, 50 points in May, 25 points in August, 25 points in November. So that's 150 points. So there you go. But a lot of that's already priced in. I'm not... So yeah, I'm not sure how much of it is left to go, but if we're right, the 1 year will be higher because the market's not fully pricing our call. They're putting pretty decent odds on it, but confirmation that we're right, if it comes, would push that rate higher still. But see our property focus for more.
Okay, and the forecast for you're forecasting a recovery in house prices in New Zealand in 2024, according to the chart that you chucked up on the screen. Do you want to expand on your assumptions that are leading to only being 1 year of negative returns and then a recovery?
Yeah, obviously there is a risk that it could be more than that, but we've got, in our forecast, we've got immigration turning positive, though not rapidly. So the fundamental housing demand supply balance is a part of it. The house prices would be at a more sensible level, particularly inflation adjusted. So the real house price ratio starts looking a lot less nutty than it was. But yeah, no, there absolutely is a risk that the house prices could continue to fall for a period. But typically you see, quite a sharp adjustment, and then it just sort of stagnates for a long time, and nobody talks about housing for a period. And it's just, you buy a house if you need one. It's quite a radical kind of world. But for calmer one. And so I guess that's in our forecast. That, yeah, the housing market just isn't really a big thing. It isn't a big driver of the economy, and it just sort of finds its level and has small positives, but much, much more in line with incomes, basically, not big real increases.
Okay. Now, one of the things, these are my questions, by the way, in case you haven't figured it out. One of the things that you talk about quite a lot in your documents that you put out is that there's quite a high margin for error in your forecast at the moment. Has there been in the last maybe couple of months a point where you're getting that your conviction's starting to get higher on your forecast, or is it still quite a high margin of error out there due to the uncertainty?
Well, every time we get comfortable with our forecast, I go and jump out on another limb. So that's what I've done with our OCR forecast. So we've certainly become a lot more confident that inflation is a big problem and that the central banks are going to have to respond to it. But of course, when you're out there on your own with an aggressive OCR call like ours, then yeah, it's a slightly scarier place to be. But in terms of the timing of the cuts, hikes, we initially thought when the CPI comes out really strong, they'll have to hike 50. So we had a 50 in May. And then we thought, but they're getting really worried, they're behind the curve and that inflation expectations are getting away on them. So, and they know CPI is going to be high, they're going to have an updated forecast that's going to show it's going to be far too high. So why would they wait? They, as far as they're concerned, they completely cleared the path in February. They said, yeah, we absolutely could move in bigger than 25 steps if we feel the need. So they will feel they've prepared the ground, and particularly now one bank is calling it. So then they'll just go in April. And then when they go in April, the market will go, oh, they're going to go again and price in 50 for May, and then they'll go, yay, free hit and take it. So that's how our thinking got from, oh, there's a chance they could go 50 in May to they're going to go back to back. So it's just maybe helpful because, yeah, as you said, you told our forecast to someone and they thought we'd been smoking something. It's quite helpful to lay out the thought process of how we ended up there, I think.
Yeah. And I think people are starting to come to terms with that, Sharon, as I said. I think they're starting to wake up to the fact that you just might be right. We've got another question come through. I don't know if you can answer this one, but I'm going to ask it because he asked me to. How much of the low unemployment is due to employment in the bloated government sector, OSH requirements, ESG requirements, work from home, all of which is causing the need for two people to do what was done by one person? Oh,
my productivity is higher when I work from home, I think. But that's a pretty negative view of work from home there in particular. Yeah, no, obviously I don't have precise numbers on all of that, but I would say that unlike, yeah, in Australia, they certainly had a period where government employment was the only game in town. That's not really been the case in New Zealand over the COVID period. But insofar as the signals coming out of the Wellington housing market, yeah, it's pretty clear the government has gotten bigger, as it tends to during Labor governments, particularly in their policy focus areas like Kaingaora and places like that. So yeah, the government employment has certainly been part of it, and in some areas, particularly housing, it would have crowded out some private sector activity insofar as they're trying to build houses at the same time everyone else is. But I think you could make a case that they're trying to rectify a market failure insofar as it's very difficult to produce affordable housing, or you can make more money doing something else. But yeah, no, I think there will be a degree of crowding out, including in the labour market, for sure. But this notion that Labor is to blame for 7% inflation is obviously fanciful. I don't think, because it's a truly global phenomenon. And yes, fiscal policy has been part of the mix everywhere, like monetary policy. They thought their priority was to backfill demand. You remember they were going to have this job scheme for people to cut down wilding pines. We can't even find people to pick apples, let alone cut down wilding pines. So yeah, there was a policy mistake there as well, and it's part of the mix for sure.
Okay. And then the last question I had on this side, unless anyone wants to type in another one. Hang on, we've got one. Should New Zealand companies and New Zealand Inc. in general diversify away from China given similar autocratic leadership as Russia? I.e., if China tries to take Taiwan, it's likely China would be uninvestable overnight.
Yeah, no, I think I am quite concerned about our concentration risk in China, which is just getting higher and higher and higher. We're pretty good at dancing on that tightrope, but our biggest strategic partner and our biggest financial economic partner aren't getting along. And there's no suggestion that tension between China and the US is going to be resolved until, it's pretty clear who's going to run the world, basically. And that would seem a while off, that resolution. And it could get more and more difficult for us. But it's a very difficult thing to suggest to exporters they might not want to take the highest price that's on offer. So how you're going to actually achieve that, you can do soft sort of stuff like trying to sign free trade agreements and sending delegations to other countries and that sort of thing. And that is going on. But in the hard data, the proportion of our exports going to China just keeps going up and up. And I think there's a bunch of countries that are looking at their trade patterns, particularly Europe and their gas, but more generally, and wondering about what risks might be built into that. Also, the other thing that's really interesting at the moment is foreign reserves, which have now been weaponized, with Russia being denied access to a huge chunk of its foreign reserves. China will be looking at all the money they've got stowed away in US treasuries and going, ooh, is that our money? Is it always going to be there for us? It could have some pretty large consequences for things like who gets to be the world's reserve currency, who funds the US government deficit. There's the pretty long-running repercussions from that move.
Okay. I think that's all the questions, and I see we're just coming on to 1 o'clock now, so we've managed to keep it bang on the hour, so well done, Sharon. Firstly, just before we finish up, I did get a couple of comments come through on a different channel pointing out that some of the slides today were quite negative. The reality is that there's nothing that Sharon said that we disagree with here at PWA. So if you are nervous about your investments, that's what you've got advisors for. So give us a call and we can certainly talk through your portfolios, how any of the views Sharon has expressed here will impact them, and maybe give you a bit of comfort around that. As Sharon has said, the slides will be made available, so we will make sure that you get a copy of those as well. And if you do have any further questions, as I said, just file them through to us, and if they're for Sharon, we'll pass them on to her. So thank you very much, Sharon, from the PWA team, from Roger, Ben, Grant, and myself, for making the time. It's really awesome to have such a high caliber of economists that we can tap in these uncertain times to give us some idea of what's coming. So really appreciate you taking the time. And once again, thank you very much.
You're welcome. Good luck out there. I'm sorry the news isn't better, but I've got to call it like I see it.
It is what it is. And that's why we like you, Sharon, because you call it like it is.
Right.
Thank you very much.
For your time. Cheers.
Thanks.